Historically, small caps have outperformed large caps in the majority of long-term market cycles. Their ability to adapt quickly to changing market conditions, along with their potential for rapid growth, suggests that they could lead the next market upturn. All right, now let's take a look at 5 small cap ETFs that you should really consider looking into for your portfolio. The S&P 500, Dow Jones, and NASDAQ have all recently hit new all-time highs, but small cap stocks have been left out of this rally. The returns have significantly lagged behind large caps. In this video, I'll discuss why this is happening and why I believe small caps are due for a massive rebound. I'll also detail 5 small cap ETFs that I love and I believe you should definitely look into and consider for your portfolio. Historically, small cap stocks have delivered superior returns over the long term compared to large cap stocks. This is hard to believe, right? The skepticism about small caps consistently outperforming large cap stocks over the long term mainly stems from small caps' higher volatility and perceived risk, their lower liquidity, and greater vulnerability to economic downturns. Small caps are not for the faint of heart, but can pay off massively for those willing to buy and hold for the long term. Data shows that from 1926 to 2023, small cap stocks have delivered an average annual return of approximately 12.1% compared to the 10.2% average annual return for large cap stocks during the same time period. However, the past 3 years have told a much different story. Small caps have lagged significantly behind the broader market, with the Russell 2000 index, a small cap benchmark, increasing by only 14% compared to the S&P 500's growth of over 30% during the same time period. So what's going on with small caps? Let's dive into why they are lagging. Small cap companies are generally perceived as riskier investments. They tend to have less diversified business models and are more exposed to economic disruptions, which can lead to greater volatility and risk for investors. Small cap stocks are interest rate sensitive. Small caps often finance their operations through debt, which may be subject to variable interest rates. As interest rates rise, these companies face increased financing costs, which can erode profit margins and reduce overall financial stability. This sensitivity to interest rates makes small caps particularly vulnerable during periods of monetary tightening by central banks, which is a scenario we've seen unfold as economies attempt to manage inflation. Next, we have sector composition. The small cap market is less represented in the high-performing technology sector, which has driven significant returns in the broader markets, notably the S&P 500. The good news is that despite these challenges, there are signs that we are due for a turnaround. Here are 3 reasons to consider buying small caps now. Number 1 is the valuation gap. Currently, small caps are trading at historically significant discounts relative to large caps. This valuation gap has widened as large caps have seen substantial price increases, particularly in tech-heavy sectors. For value-oriented investors, this presents a potential opportunity for substantial gains as small caps are relatively cheaper, making them attractive investment targets as market conditions stabilize. Number 2 is the economic environment. With the potential for a soft landing of the economy and the anticipation of stabilizing or even decreasing interest rates, small caps are positioned to benefit. Lower interest rates would reduce their borrowing costs and support expansion and growth initiatives. Additionally, a recovering economy typically favors the cyclical sectors where small caps are heavily positioned, such as consumer discretionary and industrials. Historically, small caps have outperformed large caps in the majority of long-term market cycles. Their ability to adapt quickly to changing market conditions, along with their potential for rapid growth, suggests that they could lead the next market upturn. As market dynamics evolve, small caps may once again come into favor, offering substantial returns to those investors who entered at a low point in their valuation cycle. All right, now let's take a look at 5 small cap ETFs that you should really consider looking into for your portfolio. But before we get into these, please take a second to consider subscribing and press the like button. Thank you. I appreciate the support. All right, the first of these small cap ETFs is the very popular iShares Russell 2000 ETF, or IWM. With an expense ratio of 0.19%, it has over $50 billion in assets under management. This strategy tracks the Russell 2000 index, which includes 2,000 small cap publicly listed companies in the US. IWM offers broad exposure to small cap companies across various sectors, including healthcare, technology, and industrials. Its broad scope allows investors to capture potential high growth companies while maintaining diversification. All right, the second ETF on this list is the iShares Core S&P Small Cap ETF, or IJR. It has a low expense ratio of 0.06% and over $60 billion in assets under management. This fund tracks the S&P 600 index, which consists of smaller companies than the Russell 2000 index. IJR focuses on smaller companies within the small cap sector, making it a more concentrated small cap ETF. This fund has historically delivered long-term returns that have outperformed other small-cap ETFs, in part due to its rigorous filtering process that excludes micro-cap stocks. All right, number 3 is the Pacer US Small Cap Cash Cows 100 ETF, or CAF. It has a higher expense ratio of 0.59%, has nearly $3 billion in assets under management, and the strategy is to utilize rules-based approach to select the top 100 small-cap stocks with the highest free cash flow yield. CAF has distinguished itself as an actively managed ETF with a focus on companies that demonstrate strong cash flow generation. The fund's filtering process excludes companies with high debt levels and instead focuses on firms with substantial growth potential. By excluding financials, it aims to mitigate interest rate sensitivity and improve performance through strategic sector allocation. Number 4 is the Vanguard Small Cap ETF, or VB. It has a low expense ratio, as you'd expect from Vanguard, of 0.05% and nearly $90 billion in assets under management. This fund tracks the CRSP US Small Cap Index. VB is among the most popular small cap ETFs with over 1,300 holdings. The ETF offers exposure to a wide range of small cap companies across various sectors. Its broad diversification and low expense ratio make it an attractive option for investors seeking exposure to small cap growth and value stocks. And number 5 is a favorite of mine, and I'm currently investing in it. It's the Schwab US Small Cap ETF, or SCHA. It has a very low expense ratio, the lowest on this list of 0.04%. It has over $10 billion in assets under management. The strategy is to track the Dow Jones US Small Cap Total Stock Market Total Return Index. SCHA offers broad coverage of the small cap segment of the US equity market with low fees. The ETF provides exposure to a broad spectrum of small cap companies with a bias towards profitability and momentum. Its low expense ratio and broad exposure make it a strong candidate for a diversified small cap exposure. While the volatility of small caps might deter some, the current market conditions coupled with historical data suggest a significant upside might be coming. Of course, I'm not a financial advisor and nothing in this video is financial advice. Please do your own research or speak with an investment professional before making any investment decisions. I really appreciate you watching. Please consider subscribing if you haven't already. Adding small caps is a great way to diversify your portfolio. If you enjoyed this video, I think you will definitely enjoy this video right here, which details 4 ETFs that I think everyone should consider for their portfolio. Take care, and I will see you next time.